Okay, if you're a 90s MFD, okay, selling mutual funds in the 1990s, or IFAs as we were allowed to call ourselves then, the gentleman next to me would need no introduction. Okay, if you were doing mutual fund business in 1990s and early 2000s, this gentleman would need no introduction. After all, how do you introduce a legend of the 90s and early 2000s? Okay, ladies and gentlemen, it's a delight to present Mr. Samir Arora, founder and fund manager at Helios Capital. Mr. Arora was the first employee of Helios Capital, which is what many of you would be knowing, in India, helping it launch what would become an enormously successful lineup of equity funds. Okay, many IFAs, I'm using the old descriptor, and investors came to know what wealth creation was after they invested with Mr. Samir Arora and his funds. Okay, so he is one of the original wealth creators for retail investors. Mr. Arora is a gold medalist from IIM Kolkata and one of the toppers of his business school in the US, Wharton, and one of the founders of the not-for-profit Ashoka University. Mr. Arora today will give a talk on India on road to global dominance, but what will you do to outperform? The stage is yours, Mr. Samir Arora. Yes. You're free to even move around.
Thank you very much. Hope everybody is awake after the lunch. Of course, many of you are missing, I guess, because we saw that in the award lottery that many of them were missing. But welcome back after lunch. Thank you very much for your kind introduction. So the topic I was given was this, that India is on road to global dominance. Of course, I have some issues related to this topic. But the second part is, even if it does that, how does it matter to you? We are here not as Indians only. In this case today, we are here as investors in funds or investors in equities. So let me talk about that. So just big picture, few lines which I didn't know that I'll be introduced like that. But I happen to have India's longest track record as a public markets fund manager. This includes everybody, whether he's a mutual fund or PMS or anything, anybody who's done it in a job sense. And when we started Alliance, we were one of the few companies which did not have a local partner. And we were competing with the big boys of today, which is HDFC and ICICI and others, who had equally big foreign partners, but also a big domestic partner. And so we were competing without having any local presence, local contact, local starting connections. And by 2003, actually, Helios Capital was India's biggest equity mutual fund. We were bigger than all these guys who came with equally big names, but also had massive local presence and familiarity. So I want to relive that again, and that's why we have now, as Helios got approval to set up a mutual fund. One day we'll come back. But those days were so good that I felt like doing it one more time. So let's say that there is strong consensus that India is doing well or will do well in the future, basically driven by these big picture macro factors, that we have favorable demographics, that some X percent, I think 40 odd percent of the world's 25 year and below are from India, that in April of 2000, that is April of this year, on some date chosen by the United Nations, India's population will exceed that of China, that China's population is already peaked, but India's population will peak in some 2060, 70. Therefore, we are all going to be very big. Also that we have done some reforms. Also that, India has progressed a lot on digitalization, and that there is general frustration with China. Therefore, all these things will help India, and therefore one day in the year 2047 or some year in which we are all gone, that India will be dominating the world. And therefore that is sort of being taken as granted. But the thing is that I will show you first of all that it does not matter for us as stock market investors. It may matter for our as an Indian citizen or Indian residents and everything associated with India otherwise, but there is no logic that growing local dominance should be celebrated only in itself by equity investors. So here look at first of all India's performance over the last 25 years. Clearly India, as per the current, this thing was not dominating the world in the last 25 years. And in this period, the Indian market in dollar terms has beaten Mr. Buffett. And Mr. Buffett over this time has beaten the US market. Therefore, in a period when India was not dominating, even at that time, India was doing well. So here you can see the performance of India versus other major markets or groups of markets, whether it's US or Berkshire or China. Clearly, China was on its path to global dominance during the last 20-25 years, but its stock market did not do anything great. In fact, it's one of the worst performing markets in the world. So let us dissociate these two things. We don't need to sell you that India is going to be the best thing ever for you to buy equities. Equities to be justified need much simpler reasons, which I will explain. But clearly, dominance and all is not a part of it. I also believe, actually, by the way, that even the reforms don't necessarily help in making stock market returns. So, for example, if today the government was to announce that in a liberalization of the banking sector, 15 new private sector banks or foreign banks have been allowed into the country, it would be viewed clearly as a reform. But that reform basically means that the current listed stocks will get badly hit as suddenly 10, 15 new competitors turn up. Every line of reform is not related every minute to what my market will do. Actually, the market benefited from the fact that the reforms were a bit disciplined, that it was still not easy for foreign investors to come in, so that the companies that we were buying had less competition. It was slowly, foreigners were allowed to come in more slowly, that the liberalization was more slowly, and that helped the current companies at various points of time to themselves improve and change. Therefore, I reject this whole thing about reforms and global dominance and all being a big reason for our future expected returns. I also don't believe that just because we have 8 crore investors instead of 3 crore investors, etc., that means you should expect higher returns from the stock market. There is no logic which says that if there are more investors, the return should be higher, but the logic could be that there will be more depth, that there will be more liquidity, that as the economy grows and there is higher demand for capital, higher demand for savings, that more participants there will help. That part I agree. But in itself, the presence of more investors in the long run should not change your returns. And India has risen in the last 25 years being one of the best performing markets despite the negatives. We have seen every negative that could have been thrown at us, from Russian crisis to Asian crisis to global financial crisis to attack on parliament to September 11 to 26/11 to COVID to demon to lockdown to everything. And the Indian market has been up, in itself a highly satisfactory 14-15% per annum, but also better than most other markets in the world over this period. And that has to be celebrated more than whether we were dominating the world or not. If we dominate the world, it's a good thing separately, but I don't think it'll change our stock market returns. So therefore, I say that the topic which I was asked to speak on, I basically sort of summarize it by saying it doesn't matter. We still have to do our original job, which is how to choose stocks and how to outperform that market. The market itself, in general, over time, should still give in this range of 13 to 15% return per annum, which ties up with our GDP growth in nominal terms. It ties up with corporate earning growth for a large part of the universe. It ties up with the equity risk premium of 6-7% or 5-6% over and above the fixed income returns that are available right now, say 7%, add 5-6% equity risk premium, and you should expect 13-15% return per annum. Even in the last 25 years, not only India grew some 14% per annum, but even the US in dollar terms went up 8% per annum, which is broadly 12-13% per annum in rupee terms. And therefore, that is a good enough return for the index to believe in equities more than having to believe in issues related to global dominance and the future of this versus that. So let's talk about building an investment philosophy. But before I talk, I'm not going to share my history performance because it's a bit good, but here I should talk about what is available in public domain. And before I say, oh, this is the philosophy on which you should invest, you must at least get some sense of where we have come from by using this. So this is only one slide which is showing that we started Helios Capital in 2005. And from 2006 to the last year, nearly every year our fund has been shortlisted for the best India fund. There are some 40-50 funds that are in this universe, and to be nearly every year in the top 5-6 names is, I don't think, easily possible. And because there is such a big churn at the top, every 2-3 years the current topper is gone, and therefore to get this consistency is the best and easy way to explain the results of our philosophy. Our actual numbers are a bit good, and one day when we are launching a mutual fund, we'll show you the specific numbers. But right now, this is the big picture thing talking about the philosophy, success in the past. So what is the philosophy? Basically, a robust philosophy requires you to answer these questions. What to buy and how much to pay for what you buy is an obvious first question. Second question is, buy with what horizon? Am I to look at a stock with a 3-year horizon or a 10-year horizon or a 1-month horizon, and why? And then, how to construct this portfolio? Should I buy 5 stocks or should I buy 25 stocks or 50 stocks, and does it matter, and what are the probability of A doing better than B? And fourth is when to sell. So all these things you need basically to be able to, in a short period of, or in a short presentation, say, where is the angle on each of these which is different from what others may think. According to us, everything that we do is, at least in thinking wise, different from what many other people believe. So let me explain. So to understand that how does the market do and how to outperform it, we must first understand the market. And here is an example to show you that a very, very large number of companies do well in the market every year. That is simply because, let us say there are 500 stocks in the universe. This I'm talking about US, then I'll show you India. It has nothing to do with India or US. It is to do with how an average is calculated. That if there are 500 stocks in the index, and my job is to beat the average return of those 500 stocks, which is the index, that level of the index will lie somewhere in the middle of those 500 stocks. And broadly, some 45% of the stocks will do better than the index, and some 55% of the stocks will do worse than the index. You can see that for each of these years. So if you look at the last column, that is the S&P 500 for the last 18 years. And the second last column is showing you the number of stocks from the index that did better than the index. So imagine last year, which was a bad year for the US, actually 283 stocks did better than the index. And the index did badly because the larger companies were doing badly, like Amazon and Google and Microsoft and all. They did much worse than the index itself. So therefore, a larger number of stocks beat. Sometimes the large cap companies do very well, and therefore the index goes up, but the average stocks don't go up as much. But still, if you see big picture over long run, broadly speaking, some 237 out of 500 stocks is the average. Which means, at the first level, your job is only to be able to divide the universe into two. Do you think it will be on this side of the index or that side of the index? If it's on the correct side of the index, your last stock will beat the index. So there is no shortage of the number of stocks that do well each year. It is not that 10 stocks do well and therefore you should build a 10 stock portfolio, or only 20 stocks do well, very large number do well. But look at the performance of the 150th best stock, which is 30% of the market. And the difference is so huge that even owning the 150th stock of the year, your returns will be mind-blowingly different from the index. So see the performance of the 150th stock any year. So let's look at, say, 2012, any year. 2012, the market was up 16%, but the 150th stock beat the market by like more than 8% or 8%. Even last year in India, you can see, market is near zero, but then there's SBI up 30%, ICICI up some 40%, or some Lemon Tree up 80%, or some Varun Beverages up 120%, all in the same market. Some 30% of the stocks are doing massively different from the market. You want to see that for India? That is required for the philosophy that we have. Look at it for India, same thing. If you had only got the 150th best performing stock of the NSE 500 every year, you would have been up 100 times while the market is up 11 times. It's a massive difference within the same universe. We don't know, we haven't yet come to how we will choose. But first to understand that in the market, some 1/3 of the stocks are doing very, very well. Similarly, some 1/3 of the stocks are doing very, very badly. It's basic, like last year you could call the tech stocks, the Piramal, all of them are down 40% while the market is zero. So the market is coming somewhere in the middle of the 500 stocks. Some 150 stocks one side are doing very well. Some 150 stocks on the other side are doing very badly. And that is all you need to understand, that what you should do. Which means what you want to do, to start with what not to do. You basically want that by your selection, because you won't know exactly whose turn it is next to do well, you must first try and avoid the stocks that go minus 30% in any year. Of course, you will not be able to avoid all of them, because you might get some stock which you thought was doing well and not doing well over time. But the idea is that there is real difference in this business of differentiating between good and bad. There is not much value in differentiating between good and good. It is not easy to know that whether next year Lemon Tree will do well, or Varun Beverages will do well, or ICICI will do well, or State Bank, but they do very well. And then some stocks do very badly. So if you could, which I'll explain how, could only differentiate that this is a good, this is bad, it is enough. Because in the good, the 240th also is beating the market, or 230th. So at the very worst, it can just beat the market. Otherwise, if it lands up in the 150th stock, which you will not know in advance, your life is set. So what we say is that use every factor possible to reject a stock. Don't worry about buying good stocks. Just try and eliminate bad stocks. The difference between using bad versus good is that bad needs one factor, and good, there is no end to the factor. So for example, if we say an employee steals money, he's bad. If an employee doesn't steal money, we don't know what it means. Let us say an employee works hard, delivers on his work, goes home on time, comes on time. Is he good? We don't know, because he might be harassing women. But if he harasses women, we don't care about what else he does. If he does not deliver his job, we don't care whether he harasses women or not, he's bad. So the thing about bad is that bad needs one factor. Good, there is no end. If you say a company, I will buy good company. So we say it has good management, but then we'll say, does it have good history? You say it has good history, does it have good future? It has good future, but does it have good valuation? There is no end. If I say it does not have a future, I'm not interested in knowing other things. If we say its history is bad, we are not interested in anything else. If we say that its accounting is bad, I want to know whether otherwise it has good prospects in terms of its product. So the end result is the same. There are 500 companies. You have to reduce it to some number of companies. You can either keep trying to buy the good, or you can keep rejecting on the flimsiest of reasons the bad. And the rejecting the flimsiest reasons bad means you are still left in the end with some 80, 100 companies in our case, where we say that it is not bad on any of these factors. Then you try and buy whichever 30, 40 that you want. But the point is that I have had nearly, my whole NAV over 25 years is up more than 300 times. And there have been many, many multi-baggers. But I can assure you, not one do you know that it will be so big. You cannot say, like we bought Bajaj Finance in 2011, that you could have ever imagined that this will go up some 100 times, or like even Varun Beverages for us is up some 5 times. Nobody knows. All you are saying is reject the bad, and from the balance with whatever left, you can say, I'll try and look at the good, and you buy 20, 30 companies, and then you let the stats work. The stats work as follows, that if you buy 30, 35 companies, theoretically some 30% have to do very well. So 9, 10 will do very well anyway on their own. And some 9, 10 will do very badly. If you use all the factors that you have, you reject for whatever reason you don't like, what you are hoping for is that that 10 becomes 12, that instead of 10 stocks doing well, some 2, 3 more do very well. Or at the very minimum, the stocks that are going to be materially different from the market on the negative side, that you have 2, 3 of them less than what the market has. But you will not precisely know that this is the stock on which I am betting. We have bought everything from making 100 times on Z to 70 times on Bajaj Finance to iShares to everything. But Kotak, we used to own 5% of the whole bank in 2003. When I left Alliance, which Birla must have got, 5% of the bank we owned. And it was still a very small position because the market cap of Kotak Bank in 2002 end, we bought it in 2002 when they were about to get the banking license. They became a bank in 2004. The market cap was $50 million. Now, does anybody believe that anybody knew that Uday Kotak, being a good broker, is also a good banker? Or that he will turn out to be a good banker, and therefore this stock will go up 300, 400 times. So when people say that we buy companies with good management, how do you know they are good management? How do you know that Aditya Puri is good management? He has come from Citibank, Malaysia. He has come there and he is one more banker. Over time you discover, oh really, this guy was very good. But when you are buying, you don't know exactly whose turn it is next. You are just trying to eliminate the bad and then let the stats work that some stocks will do very well. That is the way we have done it so consistently across time. So basically what we are saying is that eliminating the bad significantly increases the probability of coming at the good and reduces the cost of any error, that at least you won't have the same proportion as the market of the bad ones. Now look at it. Everybody in the country knows which are bad stocks to a large extent. Everybody knows that some stocks are very obscenely priced. Some stocks have very bad history. Some stocks have very bad accounting. But people trade off by saying, oh, this everybody knows. Or they may say this is discounted. Or they may say that that is why it is so cheap. Or for a company which is very expensive, they might say, but it is very good management. The beauty is you don't need to trade off. You don't need to trade off because so many companies do well. When so many companies do well, why trade off? You can reject a company because it's very expensive, or you can reject a company because very bad history. It doesn't matter what is the reason. But these are the reasons we find which normally prevent a stock from doing well. And we don't want any of these in our universe as far as possible. We don't want a bad theme. We don't want an unfavorable industry. We don't want potential for disruption or any history weakness that we know in management or any corporate governance that we know. It's not that we can anticipate, but whatever we know, those should be eliminated. We don't want any negative medium-term financial results, and we don't want very high valuation. And then for each of these, over time, I can answer. But we made how to analyze a theme, what is a good industry, all that we have done, so that the analysts and me know that how are we looking. So for example, today we consider infra as a bad theme simply because the infra customer never, company never gets paid because the client is mostly the government of India, and the government of India either pays very late or never pays, or when they lose arbitration they don't pay, and it's not worth the hassle of buying a company which has got very good earnings but very poor balance sheet. So now these things, out of 100 infra companies, maybe one company is actually not in that bad position and therefore is doing well, but we will reject all of them because we know that a very large number of companies do well. So there is no need to accept any expected weakness on this ground, even if currently it is not weak. Then the next question is investment time horizon. And here we are very clear that we don't want to take decisions which talk about very long-term quality of management and very long-term growth rates. You know, people say, this is a 20-year story and this is a 10-year story, which means you are able to analyze this company for 10 years, you are able to analyze this management for 10 years. So let me quickly show you some examples. So this is a very famous book called Built to Last. These guys were, I think, Stanford professors and McKinsey partners. So they have access to companies which is much more than what a stock market fund manager may have. So they did a study of companies that had outperformed the market from 1926 to 1990. And then they studied them and found out what is common among them, what is the good thing that happened in these companies, how come these companies did so well. And then they found that these are the successful habits of visionary companies. That there is no tyranny of the or, which means they won't say this or that, they will try and do both, or they will have cult-like culture, or they have ingrown, homegrown management, all the things which you associate and say, wow, what great that we have analyzed these companies. Now please understand, their analysis of the managements was with the access of inside information about the management, because it was not a stock market book. He was writing about management practices. They were professors and they were McKinsey consultants, so therefore they had more access. So after doing this study, the companies that they found, nearly all of them have gone bankrupt since then. So here you expect us to, by looking at history, say that for the next 10 years and 20 years, these companies will do well because they have good management and they have got this thing, and their succession plan is there and they have hairy goals. So look at the companies, and out of them, you know, Citi, Ford, GE, HP, Boeing, IBM, Motorola, Nordstrom are all gone. And the whole study of so many, whatever people and their analysts was done with this. So later on when this guy was asked, he said the book never promised that these companies would be great, just that they were once great. Now look at this another book called Good to Great. So this guy again studied some 2,000 pages of interviews and whatever, 6,000 articles. Please remember, this kind of research our fund managers cannot do. So when a fund manager comes and says, I have done research and this management is a 20-year story and all that, please note. So these guys wrote books, and they said, control the brute, confront the facts, discipline culture, technology accelerator, blah, 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 all the good things that you talk about companies when you want to buy them for 20 years. And see the companies that they discovered, all of them gone in 10, 15 years. Look at the Fortune most admired companies, which is a sign of whatever people like at that time. Like today, people, till today morning, they liked Bajaj Finance or Asian Paints. And look here, at 1990, and then look at 2000, 80% of the companies have changed. And in 2010, the companies are changed. And then 2020, some are same, but you know next time they won't be there. But you can see even a change. Every 10 years, 5 new companies turn up. So we say a different thing. We say you are looking at a stock only with a 1 to 3 year horizon. In 1 to 3 years, mostly you are expecting the current management to stay. You are expecting current government policies same. You are expecting same current government. You are expecting similar interest rate. Something that you can broadly sense and feel. We are not going to buy a stock if somebody tells us it's a 10-year story. It, according to us, should do well in the 1, 2, 3-year period. And if it does well, we will hold it for another 1, 2, 3-year period. But every day we are evaluating it for the next 1, 2 years and not for 5 and 10 years. And this is just the way the mutual fund industry in India and in the world has, knowing that you can't predict the future to that extent, to randomly talk of that kind of long-term growth of 10 and 20 years, it will come from a few of the stocks that you hold, and you can hold them for a long time, but you cannot know that in advance. That is our whole theory. So here we hold HDFC Bank for 26 years. Even personally, I've held it for about 25 years, but we say we are not long-term investors in the bank. The reason being that every quarter we analyze it. If every quarter we analyze it, which means if it was doing badly, we would have sold it off. If you would have sold it off, how are you long-term investor? How does Mr. Buffett say, put all your eggs in one basket and watch the basket closely? If you watch the basket closely and one of the eggs has turned bad, that means you are going to throw out that egg. If you're not going to throw out that egg, then why are you watching the basket closely? And if you're going to watch the basket closely every day, how are you long-term investor? Long-term investor means put all your eggs in one basket and go on a cruise. The fact that you're all the time monitoring, just because they are doing well, you are holding, does not make you long-term. Therefore, we said give up this nonsensical brainwashing that we are long-term investors. We are long-term investors if you are doing well. We have come in with a 1 to 3 year view. You will be given 1 to 2 years to do whatever you are supposed to do, and otherwise tell us why more time should be given. But we will not go in saying it's a 10-year story, therefore in year 8 all things will work out. Then the thing is how to deal with quality or known, because there are many companies in our market that everybody knows are good companies. There are some companies that you are not discovering the company, you are choosing that company. And there are some companies you are discovering because you have bought them early. But how do you deal with a company which everybody knows is broadly good? Because neither you have any extra factor over it. So we say, but what is a quality company? In our market and in every market, if a company is doing well, we call it quality company. There is no other definition. If a stock price is up, we call it quality company. And this is from this very good book called the Halo Effect. That when a company posts high profit and its stock price is moving, we say we own quality company. So let me show you an actual example. So in May 2000, Cisco was one of the most highly respected companies in the US, and the price of the stock was $80, and it came on the cover of Fortune magazine about Cisco, and the magazine then said that these are truly outstanding companies, that they are very customer-focused company, that everybody flies coach, so it's a cost-conscious company, blah, blah, blah. And then the tech correction happened. And the stock fell to $15 in 1 year. And the same Fortune magazine in 2001 says, it's a very bad company. It has cavalier attitude towards potential customers. 1 year ago they were saying it has one of the most customer focus that you will ever find. That they now said that the sales techniques are very irksome, very tiresome, and everything has failed Cisco. So that is the reality of the perception that people have, and that you cannot go long term. So we say the following, knowing that there is a halo effect, that means the company that is currently doing well is suffering from a halo effect, because when the stock does well, you think everything that it does do well. Now their management is good, their employees are motivated, they have a long-term plan, they have depth of management, everything is good, but you know that you are being influenced by halo effect, but it is also very expensive. So what will you do for this kind of thing? Or on the other hand, you know a company is very bad, let's say Vedanta, you know that the Mr. Agarwal is a bad promoter, but today the stock is very cheap, so what will you do? So we say you don't have to do anything, you can reject both. Because remember the original slide, that a very large number of companies do well each year. So if you reject 10 extra companies because you think that they are very expensive, or you reject 10 companies because you think they are very bad history, it does not matter. You will still have 130 companies you can try for. If you believe that only 10, 20 companies do well, you will be much more paranoid. So therefore we say you should own, depending on the time. Okay, I have a few more minutes. So in terms of building a portfolio, we say that you have to be the casino and not the gambler. So what does that mean? That when you go to a casino, you're playing, both of you are playing the same gamble, except there is a small advantage to the casino when you play the game. For example, when you play the roulette and you get 36 times your money, actual numbers on the board are 38 because there's a 0 and a double 0. So you might still, suppose you bet on number 5 and number 5 comes, you will get 36 times your money. But the probability of your getting number 5 is 1 over 38 because there are 38 numbers on the board. So the probability of winning is 1 over 38, but if you win, you will get 36. So there's a small advantage to the casino. That small advantage to the casino is not so big that you will not play. You will play, but if you play 100 times, 1,000 times, you are guaranteed to lose more or less because the stats will work in the favor of the casino. It's the same thing in our business. If we do research, if we read the annual report, if we meet the management, there is no guarantee. It just means we have a small advantage over the market which did not do this thing. It is not some life-changing thing that I met the management, therefore I will bet 100 on 100 on this. Therefore, the portfolio has to have a few more stocks to take care of the fact that you do what you want, you will never get 100% right. So we say that you should own two kinds of stocks. One is these big names, obvious names, where you are choosing the names, whether it's HDFC Bank or ICICI Bank or whatever, which you did not find expensive, did not find bad history, bad governance, bad whatever, and then you bought the good names, and you're buying half the portfolio of such names. And then there are these companies that you are discovering, which are the new companies, newer companies, new listings, old companies doing badly. Some company like after COVID, if you buy Indian hotels, the hotel is closed. So these are not companies where you can buy 5-7% of your portfolio. You buy 2%, 20 names. And anyway, according to the formula, some 30% are supposed to do well. And if you get 40% doing well or 50% doing well, you will beat the market. And that is how we've beaten the market, maybe 75% of the 1-year periods and nearly 100% of the 4-5 year periods. And so that is the way, and we can go on. But broadly speaking, the idea is that none of these things will change whether the country is dominant in the world, which we hope separately it is. But let us not get carried away by that and forget our own jobs, which is to manage the portfolio every day and try and beat the market every time. Thank you very much.